Thank you very much. First of all, thank you very much for the Barcelona GSE for this wonderful invitation. It's wonderful to be in Barcelona. I'm so impressed every time I come here about the wonderful community of academics we've been able to build. And thank you very much, Jose Luis, for the opportunity of actually discussing this, Nessie and everyone, Teresa and everyone who has been very kind to me during this day. So I want to actually, I prepared a little bit of a presentation which is a little bit more in the angle of trying to understand some of the things that we've seen recently, both in Europe and in the United States, and actually have a slightly different take than the one Albert and Jordi had. So this I took from a wonderful work that Luc Leven and Fabian Valencia have on this systemic banking crisis database. It only goes back to the mid-70s, but essentially, the point that a lot of these banking scholars are trying to make is that for whatever reason that we don't understand very well, and that's the point that I want to make, banking crises are becoming more frequent and bigger. And, when I was leaving Columbia and I was telling my colleague Charlie Calomiris that I was going to sit in this panel, he, of course, informed me of 10 papers he had written since the last we talked, which was the week before, basically documenting, going back even earlier, that the frequency of banking crises has not changed. It's the severity of them that has changed, okay? And the costs in terms of GDP, they're getting bigger, which is not surprising because we have very large banking systems. And in fact, the costs are bigger in developed economies than in emerging economies. That's Luc Leven's and Fabian Valencia's finding. Another finding that I thought of including, but I thought it was kind of silly, is that the banking crisis mostly happen in September. But I don't have an interpretation for that. So, of course, you have to, if you had to think about regulation, you have to think about exactly what is that banks do. And I think Jordi was spot on this matter on exactly the social role of banks. And, trying to think a little bit about this, while I was thinking about this presentation, I was thinking, well, they do a lot of retail and commercial banking, of course. Some of the banks do a lot of clearing services for their customers. They do custodial services, which are very important in today's economy, payment system like Citi. And of course, they have capital market activities, whether it be prop trading, as Jordi was mentioning, underwriting activities, dealership in over-the-counter markets, and so on and so forth. Needless to say, what you want to think about from a theoretical point of view is what is the optimal organization of the provision of financial services. And you want to ask yourself whether you want to have all these activities bundled with the same umbrella. And that actually remains to be done. There's a literature, and Jordi was hinting at that, about the economies of scale, but it's actually very uncertain what the economies of scale are when it comes to bundling all of these activities. And it's not that I have anything very profound to say about this, but I will come back to this issue in a moment, okay? Because in particular, you want to discover what are the sources of risk. I mean, by the way, we get banking crises of all varieties. That's true. They mostly relate to real estate at the end of the day, okay? But you want to understand what exactly should be regulated among all those different activities, okay? So I thought of, what I did was basically collect the data from the SIFIs, the ones that have been classified as SIFIs in the United States, and just put the total assets of all those entities for you guys. As you can see, well, the universal banks, JP Morgan, this is for the US data, okay? JP Morgan Chase, Bank of America, Citi, well, we're talking about, balance sheets in the trillions. So JP Morgan Chase is now the largest with almost 2.5 trillion in total assets. Then you have the investment banks, Goldman and Morgan Stanley, the investment service firms, people like Boni, which is basically custodial and payment services. Then you have the smaller retail and commercial banks, the local banks in the United States, things like SunTrust, which have a big presence in the south of the United States. And then you have other things like the insurance companies, and there you have our old friend AIG, the guys who have my life insurance contract, AICREF, and so on and so forth, okay? So just imagine for a moment about this plot in Europe or just in Spain, how would it look? So the banking system in the United States is actually not that big as a percentage of GDP. So a bank, if you think about the GDP of the United States being a number between 15 and 16 trillion dollars, JP Morgan Chase is not a particularly big bank. Just, think about Santander, BBVA, CaixaBank, and, Bankia. The percentage they account for GDP, they would be much higher than any of these banks. So, of course, we need to regulate. Now, the thing is that there are a lot of these banks that engage in activities other than just simply commercial and retail banking. So what I decided to do for you in order to just give you a flavor of the complexity, and I'm sure many of you know this, I just put the notional derivatives book value for many of these entities. The OCC issues a quarterly report on derivatives, on OTC transactions, and the number is in billions of dollars, by the way. So the way to read the notional book of JP Morgan Chase is $70 trillion. Okay, of Citi is around 60. Of Goldman Sachs is around on the north of $40 trillion of notional book. Now, needless to say, for those of you who are familiar on how derivatives work, the credit exposure is not that, that number looks huge, that looks very big. But of course, the credit exposure is much smaller because these guys are dealers. Essentially, the dealership market for derivatives contracts is essentially an oligopoly. They run balance books, okay? And so there's a lot of hedging going on. But the OCC tries to give you a little bit of the credit exposure as a percentage of book equity, and there you have the numbers on top of the bars of the different colors. And I want you to focus just for a moment about Wells Fargo, which is a bank that came out very well of the current banking crisis in the United States. This is a plain vanilla commercial bank. It looks a little bit like the banks that we're familiar with, has nice operating margins, has been free of any of the problems that have plagued other banks in the United States. In fact, they're now present in the state of New York, pissing off Citibank, who wanted to acquire Wachovia, and the Fed would have none of it. And now Citi has to deal with the competition of Wells Fargo precisely because they're able to skip a lot of the losses. Okay, so size and complexity and concentration. The other trend that we see in the United States is there's been an enormous amount of consolidation in the banking sector. In the United States, exactly what we're seeing right now, for instance, in Spain. So the share of bank holding company assets of top 10 companies in 1991 was 30%. Now it's on the north of 60%. So the number of US commercial banks is down. In addition, the complexity has increased enormously. So the number of separate legal entities in bank holding companies, they have more than 2,000 subsidiaries for the four most complex ones. And two have more than 3,000, one being Citi, which is essentially an unmanageable institution. And in 1981, you only had one firm with more than 500 different legal entities. So something is changing. The size is becoming bigger. The business is becoming more concentrated. These guys are becoming more complex. And we're struggling precisely with the issue with how to regulate this changing landscape when it comes to banking. And I reflect about what I've seen in the United States and what I'm seeing in Europe, and I see some massive changes. Some of them, of course, more welcome than others, it goes without saying. And I agree with some of the things that Jordi was saying and less so with others, but I'm sure we'll have time to discuss. So let me just tell you a little bit about Dodd-Frank, which, as you know, is a massive effort by part of the US authorities to reshape the regulatory environment in the United States. So we're talking a lot, when we talk about regulation, we're kind of thinking about prudential regulation, things like capital requirements, liquidity requirements. Those things are important. We make them right or wrong. We may disagree about whether the capital requirement should be 8% or 25%, as at Matty and Helwig would have it. But to me, what is striking about what we're doing is the enormous amount of discretion we're giving to authorities. It's not so much we're putting these rules in place. We keep putting them. We keep failing at preventing this kind of banking crisis. And I think the regulators are reacting to this by basically increasing the discretionality in the hands of bank supervisors and these resolution boards, if you want to call it this way. So in the United States, as you know, Dodd-Frank creates something called the Financial Stability Oversight Board. I don't know what the C stands for. I always, I cannot keep track of all these acronyms, okay? But it's basically chaired by the Treasury, and it's basically these guys are going to sit down on a regular basis and decide who is a systemic institution, whether you're doing well or not, whether I'm going to go in, do some preemptive corrective action, which we already had in the United States in fiducia, by the way, decide on capital requirements and decide on things that you need to do in order for me to feel comfortable, okay? Dodd-Frank, of course, the famous thing about Dodd-Frank is that Title II, or Title III, I'm beginning to forget, other liquidation authority, okay? Which is basically, in the United States, as you know, we have a system which is every time a bank gets into trouble, we give it to the Federal Deposit Insurance Corporation and they do their magic and everything works out well. So now what we're gonna do is basically give to the FDIC everything, absolutely everything. We're gonna lever their expertise, of which I would claim in a moment they have none. And whenever next Lehman gets into trouble, we're gonna give it to the FDIC to manage the resolution of a complex financial entity such as Lehman. Okay, Now, we're doing similar things in Europe, by the way. You know, we have all these capital requirement directive 4 and things like this, those things that we're trying to do. In terms of bank supervision, as you know, we now have inside the ECB, the supervisory board. The same way we're giving, you know, we're going to be transferring some of the responsibilities that were the traditional domain of a particular class of supervisors. We're doing the same thing in Europe, even though there's no, I mean, just getting this off the ground is going to be quite complicated. So something that worries me enormously is that the next crisis that we're going to have, and I can assure you we'll have another big banking crisis, because they come all the time, you know, we'll catch a lot of these regulators with very little experience. They just don't have it. The FDIC has no experience whatsoever in handling something like Lehman. They have a lot of experience in handling something like IndyMac, very standard bank in California, your plain vanilla bank. Deposit insurance, of course, remains with the FDIC. We have nothing of the sort in Europe. We have now the single resolution mechanism proposal taking off in Europe, which is basically the way it's going to work is you have a party, both in the United States, is the Financial Stability Oversight Council, deciding this entity needs to be handled and then transferred to the FDIC. The same way in Europe, we're going to have the supervisory board inside the ECB saying, I'm concerned about this, and transferring to the single resolution mechanism authorities, the liquidation, resolution, whatever the magic do, okay? So the rules versus discretion, we talk a lot about these rules. They're important, of course, let's get them right. I agree with Jordi about the social costs associated with getting our capital requirements wrong. But what I see going forward is an enormous amount of discretionality that we're building in our system. And my fear is that the incentives are going to be for these institutions to get even bigger and more complex. Just to close, I have you can think about the resolution mechanisms that we have in place as being bankruptcy. And by the way, I very much, if you haven't read the Lehman report on the bankruptcy procedures, I very much recommend. It's 3,000 pages, but every one of them is worth it, okay? It's full of ideas for wonderful papers and thesis topics, and it's just, the stories are so much fun, okay? But it's a bankruptcy procedure that worked relatively well. Through the shock of seeing Lehman go down, we're still debating heavily in the United States what that signal was, okay? But, you know, bankruptcy is something we've given up, and we have to, I'll come back to this point in a moment. Or the liquidation authority, which is what we have in Europe, in the United States, I'm sorry, and then the spelling type of idea that I'm going to go in, and without any judicial review whatsoever, I'm going to basically reshuffle the liabilities, impose losses here and there, fine if I need to, and I will enter as a senior, as a taxpayer, and do, you know, with an enormous amount of latitude by part of the authorities, you know, and I share, you know, a little bit, you know, I don't know if you mentioned it in this occasion or another one, Jordi's concerned once about the general equilibrium implications of these laws, you know. But this is all without any type of judicial review. We better get very good supervisors and regulators in these bodies, because there's not going to be any appeal. And the appeal process embedded in Dodd-Frank is incredible. You know, you have 24 hours to decide whether what the FDIC is doing with this bridge financial institution that we're setting up to place these assets is the right thing or not. So good luck on assessing that portfolio and decision in 24 hours. So these are the choice menu that we have. I'm going to leave it at that, and I'm sure